I guess I've been asked to take over the chairing the mortgage committee because Ann Foley retired last month, sadly, because she did a great job, but I'm happy to help. So I have the agenda, and it was interesting, although we have action items, there was the monthly tracking report was the first report in the package. I didn't know whether we want to go over that at all, or is that just for information?
Yeah, the tracking report is just for information, and we don't usually, it's not part of the agenda per se, but we're happy to answer any questions if you have any.
Okay. And do we have a quorum of board members, Colin?
Would you like me to do the roll call?
Sure. Thanks, Shelley.
Wendy Clark.
I'm here.
Heidi Dillinger.
I'm here.
Eileen Osborne.
Here.
Sheila Mascara-Bruno is not here. Lisa Tepper-Bates.
Here.
And Greg Ubaldi. Doesn't sound like Greg is here.
I saw him, actually.
I thought we did too.
Here. Can you hear me now?
Yes.
Yeah.
Yes.
Okay.
Okay.
You do have
Great.
a quorum.
Okay, terrific. Thank you. All right, so first up on the agenda is Mapleview Towers, and Colette Stover is going to present.
Hi, good morning. This is a board action for Mapleview Towers in Stamford, and we are asking the board to approve the prepayment of CHFA ITA loan with an approximate payoff of $2.1 million, as well as the use of residual receipts in the approximate amount of $646,000 to be loaned as part of the recapitalization. We are also seeking taxes and bond proceeds for a permanent first mortgage loan of up to $24,350,000. Maximum term up to 40 years, interest rate up to 4.5%. The mortgagor, Mapleview Tower Preservation, is an entity formed by the developer who is an affiliate of the related companies. This is an existing 7-story single high-rise elevator building built in 1979. There are 100 affordable units and 1 staff unit. There is an existing project-based Section 8 contract serving elderly population 62 years and older at or below 50% of the AMI. It's located in downtown Stamford and is within 1 mile walking distance of the Metro Center. A full-time resident service coordinator will be added to the staffing plan. Related Companies is the managing general partner of the Sellers Partnership, and this transaction will acquire all remaining interest, and any prior outstanding debt will be retired. And that includes the existing CHFA ITA loan that originated in 2002 in the amount of approximately $3.7 million for property improvements, and that has a maturity date in 2030. They will be seeking a renewal of the 20-year project-based Section 8 contract, and this is planned under HUD's markup to market option. And this option allows up to 100% of surplus cash at year-end for distribution. If that Section 8 contract expires or is failed to be renewed, then CHFA's distribution limitation of 10% of owner equity will apply. The existing residual receipts have been requested to be used as as a source of funds in the project, and we made a determination that the use of these funds would benefit the project, and we're proposing to loan them as a cash flow note, and payments would be made based on available cash up to 50%. The prepayment provisions will be available at year 15 if the borrower refinances with CHFA. Otherwise, prepayment will be allowed at year 20. Prepayment prior to the loan maturity is subject to a fee, which is 1% of the outstanding principal balance. The developer has requested that the operating reserve be sized to 3 months of operating expenses and debt service rather than 6 months in accordance with CHFA guidelines. The tax credit investor, Raymond James, has agreed to this, and it's memorialized in their executed letter of interest. We are supportive of the exception for a number of reasons, including that there's adequate cash flow that could be utilized in the event that the operating reserve was not adequate. And typically, larger elderly projects do not exhaust or utilize the operating reserves to the same degree that a family property does. Related does have a very large portfolio and could conceivably assist this project if it became necessary to do so. The closing is expected in 2020, and there's a 12-month renovation plan. The proposed scope of work includes kitchen and bathroom upgrades, flooring replacements throughout, 100% window replacement, structural work, including facade and parapet repairs, ADA accessibility work, landscaping improvements, asphalt repairs and paving, common area upgrades, and enhancements to the security system. The high cost is largely attributable to the acquisition price, which is $24 million. And this is supported by CHFA's commissioned appraisal, which estimates the as-is market value at $24.9 million. The developer is proposing a moderate scope of work of approximately $4.5 million, and the per unit rehab amount is approximately $45,000. Temporary relocation for up to 14 days is planned, and there will be no permanent relocation. This is an experienced development team. The developer is an entity formed by the related companies, and they acquire, recapitalize, rehabilitate, and preserve existing affordable housing properties around the country. And they have a portfolio valued at over $30 billion with properties around the globe. Tridus Construction is a general contractor, and they have completed a number of projects throughout the state and are well-versed in occupied spaces. Related Management Company is both the current and the proposed property manager, and they manage approximately 24,000 affordable units related, and that includes a number of CHFA LIHTC properties, and they are currently in LIHTC compliance and have no outstanding issues. Environmental reports, testing, and reviews are completed and acceptable. Additional sources include LIHTC equity of approximately $8.3 million, income from operations of approximately $1.1, and a deferred developer fee of approximately $62,000. The strength of this project include the fact that we're preserving an existing 100-unit affordable elderly housing project, and it's nearly 100% occupied. This will improve the physical condition of the property, and scarce DOH resources are not needed. The development team has a proven track record of successfully developing and managing properties. Some of the challenges include the fact the developer has established an aggressive closing timeline, and the project includes temporary relocation of residents during the COVID-19 pandemic. Some of the mitigating factors include the fact that this is a very experienced team, and the Section 8 contract will help ensure that there's adequate income that exists for the principal and interest payments. In response to COVID-19, Related has assembled a task force and has formulated a response plan for renovation sites. In addition to CHFA standard closing conditions, the following will be required. We need HUD approval of the transfer of the property and the assignment of the Section 8 contract. We need approval from HUD for the new 20-year Section 8 contract. We also need confirmation from HUD that we can loan the residual receipts into the project. If for some reason they determine that we are not able to do that, then we've discussed with the developer increasing their fee, their deferred fee, and we would look at sizing the loan as necessary up to amount that we're seeking approval for today. Any questions?
Well, as far as I can tell, the developer is not putting in any money except for deferring their development fee. So why the rush on their part? Is there some benefit for them to acquire this year?
I think they're looking to do it in this year because of the year of the bond. They were looking to have 2020 bonds. I can also say that this is a very similar deal to Market Square, which came to board last month.
Right.
And so we will certainly have, I think, an expedited closing just because we're working with that development team on a very similar closing right now.
So it's feasible from your perspective to do it?
It could be.
How long will it take for the HUD approvals and consent?
That's a good question. We've been having conversations with HUD for quite some time now, so that is a concern. We don't have specific turnaround time for them.
Are the market conditions in Fairfield County, in other words, we're seeing values go up, a concern with regards to the closing timeline or expiration of the appraisal, for example? Obviously, it's going to be a more, expensive acquisition price in that area, the area where we need to be preserving and developing new. Just curious more than anything as to whether there's concern on the part of any parties involved about that.
That hasn't been a concern that we've noted or are concerned at this point for this transaction.
Heidi, aren't developers always in a rush to get their deals closed?
Yes, they are.
Oh, this has to be done.
Right. No, because they're not putting any money in.
Right.
They're getting some economies of scale because they're going to have more units. But I just curious. I just always like to understand the behind the scenes. What's the motivation? $240,000 a unit, though, it seems very reasonable, right? You couldn't build it for that. And even with the extra $45,000 per unit, it's necessary. We need to preserve these units. So I'm all in favor of it. I just like to understand people's rationale or motivations.
Well, the interesting thing is they didn't make the 2020 bond issue. That's out of the question. The bonds have already been issued. So they're looking at 21. So I'm kind of curious as to the rush as well, because in this, they're used to both.
Yeah.
Can I ask one question as well? Apologies, Colette. Just if you could respond, what is the current footprint of Related in Connecticut?
So they currently manage Augusta Homes, Mohican Senior Apartments, and River Run. That's the management company. I don't have a good perspective on what they have in ownership of in the state.
Yeah, I just wanted to flag the fact that this is it's a big company. It's a company with a very good reputation. So it seems like this is an excellent opportunity to encourage their engagement in Connecticut. I may be wrong about this, but I don't think they have been as active in our market as in others. So I think that's an attractive feature of this. Just wanted to flag that, and others on this call might have other information as well, but I think that's an interesting part of this opportunity.
Anybody else have any other questions? Hopefully we have enough to make, from my perspective, it looks like a positive project that we need to
I'll make a motion that we approve it.
Okay, thanks, Greg.
Second.
Lisa, second. Shirley, do you want to call the roll?
Wendy Clark?
Yes.
Heidi DeWinger?
Aye.
Kylie Gosselin?
Yes.
Lisa Tepper-Bates? Aye. Frankie Baldi?
Aye.
Unanimous.
Thank you. Okay, second on the agenda is the Cherry Street lots. Michelle Onofrio to present.
So actually, we've been working behind the scenes to try to get this to move forward, and it's not quite ready for prime time.
Okay.
So we have until next month to bring it forward, and so we're gonna hold off on that. We've had to amend the agenda to take it off. So apologies for that.
No problem. Okay, so we're going to table that for Cherry Street for this meeting.
Yep.
Okay, Down Payment Assistance Program, Valencia Taft Jackson.
Good morning, everyone. The single-family department is going to be implementing changes to the down payment assistance program. And the reason why we are bringing this forward is because in 2018, we restructured the down payment assistance program because we were concerned that the level of funding was at risk of depletion due to the high demand of the loan product and the rate of disbursements from the fund. The revision that was put in place in 2018 was to eliminate the closing costs as part of the total down payment assistance loan amount. And it did have a positive impact in that it worked to do what we had expected. The revisions allowed us to slow the depletion of the funds in the DAP fund so that we would be able to offer down payment assistance to more people. And we thought that by eliminating the closing costs, we would be encouraging the potential homeowner to build their own reserves and to become more financially savvy with regards to their management of their funds. Unfortunately, what we found was that with COVID-19 and also the market conditions, the home buyers were not able to actually meet that requirement and save the additional money. So in order for us to continue to provide the funds to the first-time home buyers that we would like to do to support their efforts, we are going to revise that program to allow us to expand and help more home buyers. The changes that we're looking to make include in setting a cap on the down payment assistance amount, allowing the down payment to now once again include both the down payment and the closing costs. We are going to increase the total debt to income ratio to 45%. We're going to increase the combined loan to value to 105%. In addition to that, we need to increase the allowable fees for the lenders that originate this product for us so that they would be able to afford to continue to offer the program for us and be willing to do it. So we're increasing the fees to $550. And we are going to discontinue allowing the resubordination of the DAP loans when an applicant chooses to refinance their mortgage out of the CHFA loan. The memo provides a little background information about the history of the down payment assistance program. We received the program at CHFA in 1995, and we have been administering it successfully ever since then. We've been taking the proceeds of the repayment of the loans and reinvesting them in the DAP fund and allocating that money to other potential home buyers. Since we have been using the program, we have helped over 33,000 first-time home buyers become homeowners with funds from the DAP program. The history tells you a little bit about what has happened since 2018 when we revised the program. The program has since been recapitalized with additional funds from the sale of bonds that went through DOH. It was recapitalized with an additional $12 million, and we are now more stable. When the program was implemented with the closing costs, with the down payment assistance only, one of the things that we sought to do was to reduce the DAP loan amount. We were very successful in doing that. It went from $8,000 to about $6,000. And so we were able to stabilize the fund, and with the influx of the additional money, we now have over $25 million in the fund, and it's very stable. So this is a good time to be able to go back and include the closing costs to be able to help more borrowers become homeowners. So if you want to look at the rationale for why we're doing what we're doing, increasing the cap to up to $20,000, by doing that, we will have a set amount of money that will be dispersed to any one borrower. We will know in advance what the maximum amount would be so that we would be able to better manage the fund for the allocation expenses, monitor the rate of depletion, and adjust for any variances that might come up that might threaten future deficits in the fund. By including the down payment and the closing costs, we are going to help borrowers who today have been pretty much priced out of the market because the home values have gone up. They haven't been able to save the money for closing costs themselves, and nor are they able to tap into other available sources of funds to cover that closing cost in this market. So by including the closing costs and allowing the total down payment amount to go up to $20,000, we will be providing an opportunity to cover both in an amount that's sufficient based on our assessment of what our average down payment and closing costs have been over the last 5 years. So that should be fine. We're going to be increasing the loan to value to 45%, which is in line with all of the other CHFA first-time homebuyer programs. They all go up to 45% with the exception of the Teachers Mortgage Assistance Program. In that program, we make allowances for a slightly higher total debt to income ratio for teachers who have student loan debt to repayment. By increasing the total debt to income to 45%, we were going to increase the applicant's capacity to be able to afford a little more home without having a significant impact on the overall loan. We're going to be increasing the loan to value back up to 105% so that we could accommodate the inclusion of the closing costs in the total down payment amount. We follow the secondary market guidelines, which is Fannie Mae, Freddie Mac, FHA, and also private mortgage insurer guidelines. And their loan to value cap is at 105% for loans with subordinate financing, and so we're going to be following that same thing. The increase, I think, on the fees for the lenders is pretty self-explanatory. We have not increased fees for the lenders in over 5 years. Of course, they are asking for some help there, and we're going to accommodate by increasing what they can collect on this product from $450 to $550. We are also going to eliminate the allowance of resubordination of second mortgages when applicants refinance the first mortgage, and we're doing that because we need to make sure that those funds are repaid and are able to go back into the DAP loan fund so that we have money available to help future homebuyers. And then one of the other things that we're going to be bringing forward to the committee next month is a request to allow us to eliminate the asset test for the down payment assistance program. Currently, in order to be eligible to receive approval for down payment assistance, or any borrower that has liquid assets over $10,000 must contribute the amount over towards the cost of acquisition of the program. We don't include their retirement funds in that when we count it, but anything else that they have has to go towards the acquisition. What we have found is that borrowers would be in a much better position if we would allow them to retain the funds so that they could meet hardships that are coming up. COVID has taught us many lessons, and one of the lessons is that if we deplete their funds when they find themselves in a situation such as the one they find themselves in today, they have an additional hardship because they don't have access to those funds. So in conclusion, we're modifying the program to create a product that's going to enable us to help more families overcome the obstacle of providing down payment and closing costs in order to be able to achieve home ownership. We will continue to review the program and to report back on the loan performance and on any issues with recapitalization. Are there any questions?
Hi, Valencia. Good morning.
Good morning.
Quick question on the origination fees. I don't know if this is the goal, but in changing those fees, are we broadening the pool of lenders? And again, I don't know if that's the goal of ours, but does it broaden the pool?
We are looking to broaden the pool of the lenders, but the increase of these fees really will not have any direct impact on that. These fees are specific to just the origination of the second mortgage loan, which is the down payment assistance, where we need to look again at our compensation for our lenders is with the overall program for the home buyers, which includes the first-time home buyer home mortgage program, our PEACH programs, all of the other programs. And we are currently looking at what we could do to maybe increase compensation for our lenders so that we could go out and expand participation in our program.
Thank you.
Valencia, it's Heidi. How do we communicate these positive changes to lenders or to homeowners or potential home buyers? How do we get the word out?
Well, the first thing that we're going to do is to publish a bulletin whenever we make a change. We have a network of bulletins that we send out to the lenders, and we have identified who the contact people are at each of our participating lenders to get that information and then disseminate it to all of the people that are responsible for working on CHFA loans. And then we have our lender training programs where we go out and we educate the lenders and we talk to them about the programs and about any changes that we have implemented. In addition to that, we work with the realtors and we provide our lender training as part of their real estate continuing education program, and they get credits for taking our course. And so we tell them about any changes in that program as well.
If I'd like to add to what Valencia said, I think she did a fantastic job of summarizing the changes. I kind of want to set the stage a little bit for you all as well by saying that, earlier this month we had a CSG advisors we've retained as our consultant to do a strategic capital analysis. And as part of that study, they looked at CHFA's resources, its programs, our financial capacity, and how we could grow and do more in 3 years than we do today, and how do we do that responsibly. And as part of that analysis, the single-family program and the down payment assistance loan program was reviewed in light of its importance to CHFA, its importance to the state to build home ownership rates, and then in comparison to other agencies across the country. And what the analysis showed was that 30 to 40% of our first-time home buyers use down payment assistance. In fact, that is not a reflection of the fact that people don't need down payment assistance. It's a reflection of the fact that they're not getting what they actually need. Often closing costs, especially in the state of Connecticut, are an enormous barrier to getting to the closing table. Real estate taxes are a significant portion of that. In addition, in terms of looking at the income side of all of this, down payment assistance loans are a good investment for the authority. They tend to be fairly high performing. There are some delinquencies, of course, but those can be managed with reserves and things like that. So the idea is we should be doing more down payment assistance for first-time home buyers. We should be building the pool of people that we reach with our efforts, and we could be more competitive vis-a-vis the conventional lender network in terms of competing not on rate, but competing on down payment assistance, which is another way of saying that we want to stay sustainable and viable, but we also want to be able to fulfill our mission. And so So that's just the background of the 10,000-foot view in terms of why we're doing this today. We have run analyses that show that this fund can support this additional level of activity, and we believe that in a few years we may be able to expand the down payment assistance using our own funding, and that's something that is a recommendation that came out of the study. So I think this is an extremely positive change. I'm very excited, and I think that we should do a wide-ranging campaign to promote this. I don't think we should limit it to the lenders. I think we should get the message out ourselves.
Agreed. And just one thing, too, Valencia, you did a good job explaining the amounts over 10,000. Just a couple comments on that. Once we identify that the number, whatever it is, for a potential home buyer, we should talk to them, maybe not outright restrict it to use it for household maintenance purposes or emergency needs, for example, but the education piece is so valuable for people that are experiencing these things, especially for the first time. So I think that a lot of times, if it's passed over and you don't call a buyer's attention to it, it can get lost in the shuffle. And I also think it helps, just as we were just saying, in the promotion of all of these efforts. I think that this is outstanding.
Great.
Agreed.
Could I ask a quick question?
Of course.
This is Lisa. And Valencia, thank you for your presentation. Both of you, it's interesting that it seems like we have not really kept up with the market with regard to the fee, because you've got what seems like a very reasonable proposal to increase the fee from $450 to $550. But is that sufficient? Does that make us more competitive? Because to the question of how we get the word out, we need motivated agents who are helping get this out there. Mm-hmm. So can you respond? Does $550 put us where we need to be, or actually is that still low? I just am curious.
Hi, Lisa. That fee is specific only to the down payment assistance program. On the first mortgage program, when lenders originate loans for us, the fees that they're able to collect are a little higher. They are able to collect the 1% origination fee, which is based on the loan amount. In addition to that, we allow them to collect $395 for processing, $395 for underwriting. They also get another 0.56% from CHFA on loans that are actually closed and purchased. So their fee is, the actual fee for the loan is not the $550. The $550 is only for the down payment assistance portion of the loan. So they originate both the first and the second mortgage loans together. That's a requirement. The first fee that I just discussed is what they can collect on the first mortgage. The $550 is what they can collect on the debt. So that in addition to what they're getting on the first, they're getting the $550 on the debt. We do know that our fees are significantly lower than fees that are paid to other lenders throughout the industry by other HFAs, and we're currently looking at that to come up with a plan. So I will expect that the board will be hearing from us in the future about maybe a new and revised compensation package for our lenders.
Okay, but that's great, Valencia. Thank you very much for that explanation. But it's still, I assume it still makes sense to you, even though that more comprehensive view of how to adjust rates for those who we're working with will be going on. You want to adjust this rate now?
Yes.
Okay.
Yeah, I think the rationale is that the down payment assistance is going to sell itself, right? It's the first that we really need to figure out what's the strategy there. Are we just offering more compensation, which will be fine if that's how we want to approach it, or do we want something in return for that? In other words, if we're looking to have loans delivered to us a little bit faster, do we compensate and incentivize lenders to do that with more pay? that kind of thing. Is there a tiered structure based on how they're delivering and performing? So.
Thank you.
Any other questions for Valencia? Okay, do we need to approve this? It seemed like it was, do we need a vote on this, Nandini?
Sure, yeah.
Okay, is there a motion?
I'll make a motion that we approve this, or are we recommending it to the board? I'll make a motion that we approve it.
We approve it, and then it's, okay, is there a second?
Yep.
Second.
Thanks, Lisa. Okay, Shelley, could you call the roll, please?
Wendy Blair?
Yes.
Katie Wingert?
Aye.
Kylie Gosselin?
Aye.
I believe the commissioner has joined. Stella Mascara Bruno? Lisa Tepper Bates?
Yes.
And Greg Uvalde?
Aye.
Unanimous.
Okay, thank you. Then next item is just a review of the minutes from the September 24th Mortgage Committee meeting. Anybody have any comments, questions, corrections? No, hearing none. Is there a motion? I'll move on. I think I can. Is there a second? Second. Okay. I think we can do it in joint. All in favor?
Aye.
Thank you.
And
Any opposed? Okay. Because you weren't there? No.
Yeah, right.
Okay. All right. And then last but not least, an update on multifamily activities by Wendy Moore. Wendy?
Hi, thank you. Good morning.
Good morning.
So a little update on the 9% round that's coming up quickly. During the past month, many pre-application meetings have been held with proposed applicants. Staff has fielded many questions that have been coming in, and we've also updated our frequently asked questions on the website, and whenever those are updated, we send out an email broadcast. So those applications will be due on November 12th. As far as closings, during September, 6 initial closings took place. They included a variety of different funding applications, such as some of them were for SSHP properties, some of them for 9% tax credit deals or CHFA financing. Again, this month we've included a report that shows the status of construction on the CHFA financed multifamily projects. As far as overview sessions and webinars, at the beginning of October, CHFA asset management staff hosted a conference for asset management staff from other New England housing finance agencies. This is a group that has been getting together for the past 30 years. Asset management staff get together. This year, since it was virtual, it's usually in person, and the states take turns hosting it. This was the first virtual conference, but it went very well. We had approximately 55 people in each session participating and sharing information. The one benefit to having a virtual conference is we were able to have more people than usually attend in person because there's no budget constraints. So that went well. We talked about Section 8 topics, low-income housing tax credits, of course, COVID-19 response, and a lot of the agenda just sort of flows as we go, and people raise things as they have questions. This week, NCSHA is holding their annual conference virtually, and we've also had staff attending those sessions. They are continuing this afternoon. CHFA staff began assisting with processing the applications from the Tenant Rental Housing Assistance Program. And in multifamily, we have about 14 people from our team that are assisting in the review of some of those applications. The Housing Authority Small Improvement Program has continued. We've had some more applications come in there. There are 8 applications totaling approximately $67,000. And as you recall, we also did the basic needs pantry, and 33 applications were processed there. On the development engagement process, which has been going on, working with DOH staff, we've continued to work on processing those applications, and there were over 140 that were received. All the calls with developers have concluded, and now DOH staff and CHFA staff have been meeting to come up with their recommendations out of that process. A couple of projects that we highlighted that will be coming to the board either next month or in early 2021. Antillian Manor is a cooperative located in New Haven. Caravetta is the proposed developer, and they're proposing a full demolition of the existing building and environmental remediation and a rebuild. There will be 31 units there. And they're proposing to use 4% tax credits, CHFA tax-exempt bonds, and additional funding is being provided by DOH and some HTCC awards that were originally, already funded. There is an existing Section 8 contract on that property, and it is planned to remain. Another property that will be coming into the mortgage committee is Hebron Terrace. This is in Willimantic. It's a state portfolio project that was originally built in 1954, and there are 90 Section 8 project-based units that will benefit from much-needed repairs. The funding there is from taxable bonds, DOH funding, and HTCC funds, as well as some energy rebates. The Housing Authority also had some reserves that have already been used to replace some of the boilers there. So that's just a highlight of some of the projects that you may see in the upcoming meetings. Are there any questions that I can answer?
Thank you, Wendy, for a terrific report, as always. I have a question for you about the following 2 issues. Are you hearing any interesting observations from developers as you meet with them about the way they feel that this current public health emergency is potentially having an impact on the market as they see it? That's one question. And the other question I wanted to ask is what type of feedback with regard to the CHFA process you might be hearing? Are there any themes that are emerging as you have these meetings?
So as far as the health crisis, we have heard about some supply chain issues that have been experienced. As far as really affecting the equity markets, I don't think there's been a large impact, but there could be a little bit. And then your other question was?
What are you hearing with regard to our process? What types of observations, if any, are emerging from your individual meetings?
So I think that the development community has appreciated this opportunity to really just provide a limited scope of information, and then as we've given them feedback and they're refining their applications, just getting that initial feedback, I think has been positive. We've heard those comments.
Thank you.
Lisa, with respect to the 9% round, we always hear things like, and I know your question wasn't specific to the 9% round, but I think for me, top of mind is always, with respect to the 9% round, developers want to know way in advance what the QAP is going to look like, right? I mean, that's just how it is, because they're building their pipeline, well in advance of when the applications are due. So, with that in mind, we have an update to the board this morning from Terry Nash, who's charged with the QAP revisions for the new year. So we have a couple of ideas about kind of how we could tweak the schedule so that we could get the QAP for 2021, 2022 finalized and also provide enough time for the development community to absorb the changes. So that's just one point of feedback we always hear. Masuda, do you have anything else you'd like to add to Wendy's comments about what we may be hearing through these DEP meetings in terms of feedback for us?
Yeah, I would say some of the feedback, it's been positive because it does give us a chance to connect with these developers very early in the process and provide them constructive feedback. In some cases, a developer may not be ready, and so we want to make sure that they've done their due diligence before they submit their proposal. So some of it is going to be a little bit more of technical assistance along the way, as well as those that are ready to go. That's one of the conversations that we will be having with DOH is how do we move forward with that process in terms of inviting those applicants and allowing them to proceed with application submission. So I would say overall, it's been a good process. I'll be honest with you, it was time consuming because between CHFA and DOH we convened, over 70 conference calls and to do it virtually in light of the COVID, that was a bit of a challenge, but I would say overall that the conversations have gone well.
And it really allows us to really come up with a strategy and build a pipeline for, the 9% of course are competitive, but on the 4% side, on the SSHPs, on conceptual projects that don't have, maybe are not ready to fund yet, kind of how do we envision, where would we put subsidy? Where, what are the areas of opportunity? What, kind of where are we looking to put these resources and how does that align with our strategic plan, right? So that's kind of like the big picture is if you're bringing all of these resources together and you've got the QAP, which is generally the 9%, but it also drives the 4% in some ways. And then you've got DOH and subsidy going into the 4s and the 9s. How do you bring all of these things together so that you're making investments to maximize impact, right? So
that's terrific the way you described that, Nandini. It's very exciting to have the opportunity with your leadership and with Masuda and our long-time staff to be thinking creatively in that space. So thank you.
Okay. Any other comments, questions, concerns for mortgage? If not, then I'll take a motion to adjourn.
So moved.
Second.
Okay. Mortgage committee, all in favor? Aye.
Thank you.
See you in a couple minutes.
Yep. Bye.
Bye.
Goodbye.